Hello students, hope all of you are fine. In this present lecture session, I am going to discuss few aggregates of national income along with the concepts of nominal GDP and real GDP. So without delay, let us begin. Now I am going to discuss four important aggregates of national income estimation: gross domestic product GDP, net domestic product shortly NDP, gross national product shortly GNP, and finally net national product shortly NNP. And that apart, we will also discuss nominal GDP and real GDP at the end of the class. Before I move to the next slide, I must tell you one thing which is very important to remember, that these four aggregates have two different versions or approaches. I mean, each of the aggregates have to be studied at factor cost and market price individually. GDP at market price. GDP at market price refers to gross market value of all the final goods and services produced within the domestic territory of a country during a specific period of time, and time is usually 1 year. Let me simplify you the definition. Gross here signifies that no provision has been made for depreciation. That means it includes depreciation. Secondly, domestic in this definition means it includes goods and services produced by all units located within the domestic territory of a country. Thirdly, market price in this definition means that includes amount of indirect taxes paid and excludes the amount of subsidy received. And fourthly, that is finally, product in this definition signifies that only final goods and services have to be included. I am not mentioning any formula here because by making adjustments in GDP at market price, you can derive other aggregates or other formula. Let me change the slide. Here is net domestic product at market price. NDP at market price refers to net market value of all the final goods and services produced within the domestic territory of a country during a specific period of time. The formula for calculation of NDP at market price is NDP at market price is equal to GDP at market price minus depreciation. So let us move to the next slide. Now, gross domestic product at factor cost. GDP at factor cost refers to gross money value of all the final goods and services produced within the domestic territory of a country during a year, usually 1 year. The formula for calculation is before you. GDP at factor cost is equal to GDP at market price minus net indirect taxes. Now, this time we will learn net domestic product at factor cost. NDP at factor cost refers to net money value of all the final goods and services produced within the domestic territory of a country during a specific period of time, usually 1 year. The formula for calculation is this: NDP at factor cost is equal to GDP at market price minus net indirect taxes minus depreciation. Students, you can note one thing. To obtain the NDP at factor cost, what we have done, we have subtracted or deducted the net indirect taxes and depreciation from GDP at market price. Why? I am going to tell you. You have to remember one thing. When we deduct net indirect tax from the market price, you get the factor cost value. And when we deduct the depreciation from the gross value, you get the net value. So that is why here in this formula, from GDP at market price, we have deducted net indirect taxes and depreciation. I hope you understood the points. Another very important aggregate of national income estimation is gross national product at market price. It refers to gross market value of all the final goods and services produced by the normal residents of a country during a particular period of time, and that is usually 1 year. The formula for this is this: GNP at market price is equal to GDP at market price plus NFIA. That means net factor income from abroad. See what has been done in the formula. Actually, what we have done, we have added NFI to the GDP at market price. As we added the NFI to the GDP, it got converted into GNP at market price. Very simple. So let me change the slide. Now what is net national product at market price? It refers to net market value of all the final goods and services produced by the normal residents of a country during a particular period of time. It can be derived if we deduct depreciation from the GNP at. Now what is gross national product at factor cost? GNP at factor cost refers to the gross money value of all the final goods and services produced by the normal residents of a country during a particular period of time. It can be derived by deducting net indirect tax from the GNP at market price. So let us go to the next slide. In this slide, I will explain you NNP at factor cost. It simply refers to the net money value of all the final goods and services produced by the normal residents of a country during a period of 1 year. Its formula is this: NNP at factor cost is equal to GNP at market price minus net indirect tax minus depreciation. Here I will discuss about nominal GDP and real GDP. The total monetary value of all the final goods and services produced in the domestic territory of a country during a year, counted on the basis of current prices of that particular year, is called nominal GDP. As you can see on the slide, nominal GDP is equal to real GDP into GDP deflator. To understand properly this concept, I have to explain you what is GDP deflator and what is current prices. GDP deflator is defined as the ratio of nominal GDP to real GDP. Nominal GDP we will get in the next slide. We also need to know what is current prices and what is constant price. Current prices measure GDP or inflation or asset prices using the actual prices we notice in the economy. Current prices means no adjustment in the inflation. On the other hand, constant prices adjust for the inflation. Using constant prices enables us to measure the actual change in the economy and not just an increase due to inflation. You can see the definition of real GDP here. The total monetary value of all the final goods and services produced in the domestic territory of a country during a year, counted on the basis of the prices of a base year, is known as real GDP. The formula for calculation is this: real GDP is equal to nominal GDP divided by GDP deflator. Let us do a practical. Here the question is, if nominal GDP is rupees 840 crores, GDP deflator is 1.4, then calculate the real GDP. As we know, real GDP is equal to nominal GDP divided by GDP deflator. So putting the values in the formula, we get the answer rupees 600 crores. With this, today's lecture session is over. If you have any question, you can post to me. Thank you so much.